A resolution to the U.S. China trade battle will give the stock market a nice bump. But some companies will benefit much more than others, especially the ones with the most exposure to China by revenue. Below, you'll find a short list that I put together with help from Goldman Sachs. But first, here's why a trade war resolution is imminent. Pressure on Trump. President Donald Trump used to love to remind voters how much their 401k plans were up, and how great the economy was. It's tough for him to make these claims now. Too bad for him, because the 2020 presidential election cycle is underway. Trump knows he needs to boast about the market and the economy to fend off challengers like Massachusetts Sen. Elizabeth Warren. One way to get there would be to resolve the tariff battle, since this would help the markets and the economy. Pressure on China's economy grew 6.6% in 2018, the lowest growth in 28 years. China's exports fell 4.4% in December and imports were off 7.6%, the worst since 2016. Trade flows are plummeting, says David Hensley, a global economist at J.P. Morgan Chase, who has turned negative on growth. China exports fell in part because of U.S. tariffs on Chinese goods. Imports fell because of a decline in domestic demand. To U.S. companies doing business in China, it's pretty clear what's going on. China's economy has weakened due in part to trade disputes, FedEx CEO Fred Smith said in his company's December conference call, one reason he lowered guidance. To improve growth, China President Xi Jinping is cutting taxes and busting credit and infrastructure spending. He knows a resolution on tariffs will help, too. The clock is ticking. A truce delayed U.S. plans to hike tariff on more Chinese goods until March 1. That's not far away. So we need to see a trade resolution soon. Otherwise, investors will get nervous and sell stocks again, and business will cut investments to hunker down. There's time pressure on Trump and Xi. If they kick the can again, they will lose credibility. Read. Peter Morici says negotiating with China may prove a fool's errand. Companies with the biggest exposure to China at most of the companies below, over half of revenue, comes from China, compared to 1% for the U.S. The first thing you notice about these companies is that most of them sell chips and tech. This means that a lot of their supposed China revenue comes from components like chips that are made in the U.S. or elsewhere and are shipped to China, inserted into products and then exported as finished products. But trade progress would still help them because their big Chinese revenue exposure still troubles investors, and holds back these stocks, for three reasons. In any prolonged trade war, China's tariffs could spread to these companies' products. Chinese consumers and companies are big buyers of the final products involved, like smartphones and networking gear. In a prolonged trade war, China could impose tariffs on products like these. The tariff battle is slowing global growth. So these tech companies get hit indirectly by tariffs. For example, the global slowdown helped cause the chip sector slump that's hurting many of the companies below. A resolution of trade tensions will help them. Read. IMF cuts world economic forecast for 2019, citing trade tensions. Here are stocks that could benefit most from the end of the trade war. Wynn Resorts. China sales, 77%. Wynn Resorts. Wynn, 3.60%, of course, has a casino in Las Vegas. But it also runs a big one in Macau. It's popular with Chinese tourists. As tariffs and trade wars slow the Chinese economy, this hurts Chinese tourism and business in Macau. So even if Macau casinos aren't direct targets for Chinese tariffs, they get hurt. China has another lever in any all-out trade war. Its tourists need visas from the Chinese government to visit Macau. All of this means elevated risks for Wynn in a bigger trade battle scenario. Likewise, the upside is there if trade tensions ease. That would improve investor sentiment toward Wynn, because Chinese tourists really like Macau. Demand for our product and for Macau in China is insatiable, Wynn Resorts CEO Matthew Maddox said in the most recent conference call. We are very big believers in the long term in Macau. Wynn Resorts pays a 2.7% dividend yield. Qualcomm China sales, 67%. Most of Qualcomm's QCOM, 0.96% CDMA technology and chips for smartphones makes a round trip to and back from China. But Chinese demand still matters. Qualcomm cited a slowdown in China demand for high-end phones as a problem in the third quarter. Worsening trade tensions could also make it harder to buy companies in China, says Qualcomm. Separately, Qualcomm faces legal battles on several fronts over royalty fees. On the bright side, Qualcomm will get a boost from 5G wireless, which Qualcomm predicts will begin to roll out in the second quarter. Qualcomm pays a 4.3% dividend yield. Qorvo China sales, 62%. Qorvo QRVO, 3.76% sells radio frequency chips for smartphones. While a lot of its chips round trip out of China, about 10% of sales come from a Chinese handset maker. About 8% of sales come from Huawei Technologies, a controversial Chinese company. Qorvo also sells to a Chinese lighting and Internet of Things company that makes smart lighting. All of this means heightened trade wars could hurt the company on several fronts. Qorvo gets 36% of its sales from Apple, AAPL 3.31%. Another risk because Apple has been guiding lower. On the bright side, Qorvo will be a big beneficiary of 5G and the ongoing expansion of 4G around the globe. Qorvo doesn't pay a dividend. Micron Technology China sales, 57%. Memory and storage chip vendor Micron Technology Mu, 6.48%, says some of its products have been hit by Chinese tariffs. China is also the source of rare earth minerals the company needs. Trade tensions have contributed to the slowdown in chip demand. CEO Sanjay Mehrotra thinks the second half of 2019 will bring a demand recovery. A trade war resolution that improved global growth would certainly help. Micron Technology doesn't pay a dividend. Broadcom China sales, 50%. Broadcom AVGO, 1.67%, sells radio frequency (RF) filters used in high-end smartphones. It also sells switches and chips for Wi-Fi, set-top boxes and enterprise storage devices. Much of Broadcom technology sold in China round trips right out, inside finished products. But Chinese spending on smartphones and cloud hardware matters. So an escalating trade war would be a big problem. A separate issue for Broadcom, Apple accounts for around 20% of sales. On the bright side, Broadcom RF filters play a key role in 4G, which is still spreading around the world, and also in 5G, which will be the next wave. The filters help screen out noise in these congested areas of spectrum. Many of its products are a play on data centers and cloud computing, where growth remains robust. The dividend yield here is 4.2%. Texas Instruments China sales, 45%. The world's largest analog chip maker, Texas Instruments TXN, 2.27%, backed away from blaming weak third-quarter demand directly on tariffs and trade wars, citing a chip market slowdown instead. But investor relations chief David Paul hinted as much. It doesn't preclude that there aren't other things and other factors, the macro things that are going on, he said. Say if an easing of trade war tensions helps improve global growth, that'll be good for Texas Instruments, which guided for flattish year-over-year sales in the fourth quarter. Texas Instruments pays a 3.2% dividend yield. Nike China sales, 14%. Nike doesn't really rank that high by China sales, at only 14%. But investor sentiment towards this stock could get a boost if China trade tensions ease, because China is such a big deal for Nike. China sales grew 20% last year, and growth has been strong for 4 years. Nike also has exposure to trade war issues because about 26% of Nike products are made in China. Nike CEO Andrew Campion attributes the strong sales trends to the growing interest in sports in China. Nike works with the Chinese government to support this trend. When sport grows, Nike grows. China is perhaps the best current example of this phenomenon, he said. Nike pays a 1.1% dividend yield. At the time of publication, Michael Brush had no positions in any stocks mentioned in this column. Brush has suggested Win, TXN, MU, QCOM and NK in his stock newsletter Brush Up on Stocks. Brush is a Manhattan-based financial writer who has covered business for The New York Times and The Economist Group, and he attended Columbia Business School in the Nightbog AHO program. Want news about Asia delivered to your inbox? Subscribe to MarketWatch's free Asia daily newsletter. Sign up here.